Private credit is gaining a lot of investor interest. Exciting, right? But let's see. Before investing, let's see how to evaluate a private credit opportunity. Hello everyone, this is Vaishali from DPNC Advisors. In part 1, we introduced private credit as a growing asset class in India. Today, let's demystify how to evaluate a private credit opportunity. When accessing a private credit opportunity, investors should focus on the following key pillars: the company's performance, the security package, the risk-reward trade-off, and the legal structure safeguards and promoters and governance quality. Now, let's start with one by one for all the points. First, company's performance and financial ratios. The first step is to understand borrower's ability to service debt. And some of the key factors, or let's say ratios, that we check are debt to equity ratio, that shows the leverage level, cash availability and cash runway, to check that whether the liquidity is sufficient to meet the obligations for the duration of the instrument, profitability and EBITDA margin. Healthy and stable margin reflects stronger repayment ability. Debt service coverage ratio and interest service coverage ratio. So these ratios indicate that whether the company generates enough earnings to comfortably meet its debt obligation, both in terms of principal and the interest repayment. The next is operating cash flows. Cash, not just accounting profit, repays debt. Consistent positive operating cash flows are critical. Equity investors. Presence of credible investors in the company or the organization improves the credit worthiness. Growth trajectory, revenue consistency, market positioning, all these factors help in accessing the stability of the future cash flows. Coming to the next point, which is evaluating a security. The next layer is to check what backs the loan. Security provide comfort in case of default. Key consideration which should be remembered is, what is the value of security in the security cover? Does the collateral sufficiently cover your amount being borrowed? Liquidity of the collateral. How quickly one can easily convert the security into the cash in case of default. The next is corporate and promoters guarantee. Please check if guarantees are legally forcible, the guarantor's financial strength, and whether they have honored the obligations in the past. The next is risk-reward trade-off. Weigh the potential returns against the inherent risk. The first point under this is yield versus risk. Return of 12 to 18% looks attractive, right? But they also come with illiquidity and credit risk. What is the payment structure? Monthly interest with bullet principal payment at the maturity is a bit riskier, since cash flow stress may pile up towards the end. So a staggered and amortized repayment structure reduces the risk. Next is tenure and exit option. Longer lock-ins means reduced flexibility. Excess if the risk premium compensate for the illiquidity. The next is diversification. Avoid overexposure to one borrower or promoter group or a sector. The next point that we'll check will be promoter's background. Numbers alone don't tell the full story, right? Access the people who are behind the business and who is better than a promoter. So please check for promoter's track record. Have they honored their past obligations or they have done any default? Alignment of the interest is also very important. Promoter equity commitment or personal guarantee shows the skin in the game. The last point that we'll evaluate is legal and structural safeguard. Even with strong financials and collateral, the deal structure matters a lot. Look for instrument type, whether it is NCD, structure loan, invoice discounting. Each has different enforceability. The seniority of the paper. Senior secured debt offer higher protection as compared to subordinate loans. What are the covenants? Restrictions on further borrowing, asset sale, or dividend payout adds the discipline. So in summary, evaluating private credit is not more about chasing high yields. It requires disciplined analysis across financials, security, legal structure, promoter quality, and risk reward. Done right, private credit can be a powerful addition to the investor's portfolio. Thank you.